Hello everybody, Joe here with another episode of 4 Minute Finance talking about pre-tax contributions into retirement accounts, 401k specifically for this example purposes. It's most widely used, but obviously a SEP IRA or a traditional IRA, same conversation for what I'm going to talk about. A different way of thinking about what that deal is you're making when you make a pre-tax retirement contribution. And something I don't often hear people talk about or really consider, and I believe it is a very interesting way to think about what the deal you're actually making is. So to give you some background, first 401k plan was put in place in 1980. In 1980, to give you an idea of the tax landscape back then, in 1980, if you were to make the highest tax bracket federally was 70%. Any income an individual earned over $108,000 of income was taxed at 70%. That is very high. I would not want to work for 30% of what I earned, right? To give you a better idea, even at $34,000 of income in 1980, above $34,100 of income, you were paying 49% tax, right? And then as you made more and more income, you paid a higher percentage up until you maxed out at 70% at that $108,000 of income limit, okay? Point being, taxes were very high. The option to not pay taxes, to make contributions into the brand new 401k plan and defer those till later, right, was very attractive to people. Quite frankly, it made a lot of sense. If you did that then and you're retiring today, you made a good decision because the tax brackets are lower, right, than they were back then. The highest tax bracket now federally is not even close to 70%, okay? So we think about it today. Let's imagine that we are in, looking at this as a business opportunity, a business deal. The government is all of our business partners. We are going to give a portion of our earnings, no matter if you're a W-2 employee or you own your own business, a portion of that's going to go to the government, okay? So we'll make math simple for me. Let's say I made $100,000 this year of earnings, okay? I'm contemplating or considering putting $10,000 into contributions for my 401k, right? $10,000. So if we think about that $100,000 of earned income this year, right, if we look at that last $10,000 of earnings that I'm contemplating giving to a 401k plan, if I did not contribute that and I took that as income or I paid tax on that income in 2019, I would pay 24%, right? The government has 24% ownership of that $10,000 in 2019, okay? So the government comes to me and they say, hey, you owe us 24% of that, we'll make you a deal. If you make this contribution to this thing called the 401k plan on a pre-tax basis, you don't owe us that 24%. We'll let you keep that. We'll come back and we'll get our money later when you take that money out. So if you were in business and you were 76% owner, they were 24% owner, you'd say, okay, well, so when I get that money back out in retirement in this case, right, or whenever down the road, I would assume I have to then pay you 24% then. That your business partner, in this case the government, is going to say, maybe, and you'd say, well, what do you mean maybe, right? And I'd say, what do you mean maybe, right? And they would tell you, well, we don't know if it'll be 24%. I'd say, oh, okay, well, what will it be? I don't know, is what the government would tell you. The future holds that answer. Can't tell you that today. I'd say, all right, well, what's it based off? Who gets to determine what that ownership is or what I have to pay you back in taxes down the road? And the government, your business partner in this case, is going to say, well, I get to determine that. I'm going to set Congress, right? More specifically, Congress gets to determine what percentage of that money I get to take on the back end. And that is based on tax brackets in the year that you take that money out of a 401k plan, which will be viewed as earned income in that year and subject to the tax brackets of that year, okay? The government is in $20 trillion, more than $20 trillion, I believe, of national debt. There's also $20 trillion in retirement contributions, right, from people using these programs over the past 40 years to save in this way, and they have their hand in that cookie jar, and they get to determine what the rate that they take the money back and you pay tax is of that money, right? that's a scary thing in my opinion. I don't want to go into business with somebody who gets to control their equity. Now, there's also, I'm not telling you it's the worst thing in the world or it's bad or it never makes sense to make pre-tax contributions. It absolutely does. General consensus in my opinion is typically do both. Pay tax on some of your contributions, use Roth IRAs, use post-tax 401k plans, use pre-tax, right? Position yourself to really be able to manage your tax brackets in retirement. But just a different way of thinking it. Hope that's helpful. Just a unique perspective that I often don't feel people or my clients really think about when they're thinking about deferring taxes. So hope that was helpful. Comment, subscribe, ask questions. I apologize it went over. So that's that.